Hey, good morning, everyone. Marty Missouri here, 12th of September 2019, Thursday. Well, I've been sitting here this morning for quite some time looking at data. A lot of it's debt related, a lot of it historical, a lot of it, of course, looking at trends during similar times like these. And there is just so much that I want to illustrate for you. It would just be impossible to do that here without taking way too much of your time. So this morning, going to do the usual, going to talk about the charts, going to talk about the very latest news, going to show you a little bit of data, repeat some that I've shown you recently, and just going to re-emphasize why we are so cautious here at PWA with our clients' money amid a market that's about to hit new all-time highs. And there'll be much more of that on the written blog. Of course, probably tomorrow you'll have a weekly message from me. And I'm just going to come at you probably several times a day with charts, quick, very quick, to the point, commentaries about the things that concern me and us right now, and why we think the most prudent thing to do is to, in a sense, and we're doing it through hedges using derivatives, but in a sense, step away from this market a bit or step back and be willing not to participate in a big way. The way we're doing it, we do get some participation, but not like we did coming off of the bottom, on December 24th of last year. But frankly, it's a different world right now. Things have morphed quite dramatically, and in my view, in the wrong direction over the past 9 months or so. And therefore, it demands that we have a different approach to portfolios. Our approach is dynamic as the markets are, and it's, of course, ever evolving with conditions. So we do not stay stuck in any one thesis. While I have resisted and countered, what I would call the doomsayers over the last 10, 11 years, I know I'm beginning to sound like one. It's not because that's my nature. It's not because that's how I want to sound. It's because that's what the data and the conditions are dictating, at least for now. And as I suggested in last night's written blog, there is a scenario where we can become bullish again, even before the next recession and bear market. Not where we are right now, but we could see the externalities that are hitting the market right now resolving positively. When we see that developing or that has developed, then of course we'll approach portfolios differently and you'll hear a different commentary herein. Okay, so anyway, I will just run through the chart as usual and then the hourly chart. Then I'll throw some quick statistics at you and let you get on with your day. And of course, you'll be looking for lots more from me on the blog going forward. So your futures chart, we are now 17 minutes before the open, S&P 500 daily chart, this upward sloping wedge pattern that I showed you on the S&P 500 index chart yesterday. Of course, it's there on the futures chart as well. These patterns tend to break out below much more often than not, but as I've been saying now for the last few weeks, I really expect to see new all-time highs before we see what is our base case, at least for now, and that would be the market rolling over and having, at a minimum, a pretty substantial correction in the not too distant future. Unequivocally, it does not have to play out that way. That's just what the charts are suggesting is where the probabilities lie right now. And the fundamentals have continued to deteriorate, which is why, frankly, the European Central Bank cut its deposit rate further into negative territory this morning and restarted the money printing and the bond buying, i.e. quantitative easing this morning as well. So just to put that into perspective, we have the Eurozone, whose economy really is in trouble. There's no question. And they've been at negative interest rates for quite some time. They had a pretty aggressive quantitative easing program for quite some time. And what's happening? The central bank is pushing interest rates further into the negative and beginning to try their best to do really nothing more than blow up asset prices and cross their fingers and hope something good comes of it in the real economy. There is a vast amount of empirical evidence that suggests when you get to this point, this is the precursor to something very, very ugly. And that's the kind of analysis that I've been doing of late and the data that I've been compiling of late and what has me and us being very cautious of late. And again, more detail on that to come going forward. Okay, so as I promised, here's the charts. So we have this really strong rally in here. This is a nice trajectory. Finally, again, broke out of this trading range we were paying very close attention to. Very typically, we come back and test this old resistance level. It in a bull market, or for the bulls, this would need to become support. You would see that bounce off of that. You'd see a lot of buying. We'd see this market push up pretty aggressively. Whether or not we get to all-time highs before we get that test, of course, that remains to be seen. But if for whatever reason we come through there with momentum, that is the kind of thing that could start a pretty precipitous kind of waterfall type selling, because where there were shorts up in here, and make no mistake, there's still some, as I suggested yesterday, I think I did in the video, and also I know in the written blog, I think a lot of the shorts have been taken out. But of course, there's going to be folks just waiting to pounce here. And if we get through there with momentum, they'll have to cover, because if you're short a stock and it keeps going, you could lose the house, so to speak. So you don't want to do that. So then when you cover, you buy, and it pushes things up further. As I suggested in yesterday's written blog as well, it feels to me, at least right now, given all the evidence, the technicals and the fundamentals, it's kind of your classic bull trap. And that is where you get these unsuspecting, unfortunately, a lot of times they are retail investors, jumping finally into the fray. And a lot of, technical bulls will see this as a good positive breakout, and they'll jump in there as well. And then you're just left with a bunch of bulls on one side of the boat. You get a little bad news, and the bears jump in and pounce, and then you've got stop losses. Essentially, it's just the opposite effect, where you had kind of a panicky short covering buying in here. Here you have panic selling, a lot of it triggered by stop losses, and there's stop losses at various areas down here, and it just kind of feeds on itself. What's happened so far when we had events or circumstances that really looked like they were going to push us through here is we got a timely tweet. It happened again last night. It happened right in here. This was a Friday. That Monday we were looking at a candle that looked very much like this. That was going to take us down through and trigger some stops. That's when the president talked about some phone calls from China that doesn't really matter at this point, but found out that didn't happen. But it was enough to say that the U.S. is really beginning to want to get to the table and get this trade war over with. And that was enough to kind of alleviate the downward pressure in here and emboldened the short-term traders to exploit what has basically happened at this point. And that is a nice rally here, moving on up into these levels. And then as I continue to illustrate, we have very definite negative divergence here in momentum. So we'll get to new all-time highs, and we will not get to a point where, technically speaking, we can get excited about this market, because we'll have a very definite negative divergence. Folks, when you have your upward sloping wedge and you have your negative divergences down here, you have a high probability of the rally failing, and a pretty good correction, or at least somewhat of a correction, whether it's a minimal correction like we had in May, something bigger like we had last fall, that remains to be seen. But until the technicals here, at least in this momentum indicator and the RSI below, begin to show us something that confirms, and that would be these things coming up and confirming the move into all-time highs, what that tells us is the underlying character of the market says that this is not to be believed, and that the smart money is ultimately fading these rallies as they go up here. So that's the sucking in of the bulls, and the smart bears taking full advantage of those late coming buyers to get themselves out of positions that they've been riding profitably, in many cases for quite some time. Then on the hourly chart, here's how that range looks. Broke out of it nicely here. Here's that big thrust Last night, when the president said that they're going to delay tariffs from October 1st to October 15th, well, you'd think the trade war ended at that moment. I showed you that last night. The market just rocketed higher on that news. So clearly, it's the trade war that's been moving markets. We came off of that last night, been bouncing around on that European central bank news. But you see, we're in this wedge. Remember, I said yesterday that a trader might want to be trading this. You go long in here, you go short at the top. Right now, anybody kind of swing trading this range looks like they're doing pretty well. I won't be at all surprised if even today we don't break above that. We'd move up in here just to extend that, and that would actually put resistance right in here. So if I were trading this, I'd probably move my line up and be prepared to short the market right there, with a buy stop up in here just in case it does break through. And then I would go long, and I'd probably trade that for a while if I were a short-term trader. Not what we're doing, of course, but it does help you get a feel for what might motivate, a move to this level. You don't get any news, suddenly the market, drops off of that. Why would that be? Well, it's because traders are playing this range right in here. In terms of the very short-term technical setups, not as bullish looking. It's beginning to break down a little bit in here. That right there, that's the signal line on the MACD. That's rolling over. That we have right here your classic, negative divergence on the MACD. You have it here on the RSI as well. You'd say, well, it's not negative, it's flat. No, well, it's negative if the market is rising and this isn't rising with it. This is considered overbought. You can see we just come plummeting off of there. This little move right here on a very short-term basis, if the market's flat and that begins to come up, well, then that's positive. I showed you that scenario here the other day and it played out pretty well. So folks, on a near-term basis, I don't know, this is somewhat ambiguous to me. I could see a lot of money rushing into this market today. The president just tweeted just a few minutes ago that China's going to be buying major quantities of U.S. ag products. Now, right now, the S&P is looking at about a third of a percentage point move at the open. Dow looks like it's going to open about 100 points higher. That's good. I mean, those are noticeable moves, but they're not monster moves that I think we'll get if and when we actually get an end to the trade war, or if the pending tariffs actually don't get delayed but get eliminated, and the pending ones to add now. That will not create a bullish fundamental backdrop for us. That'll just be something that traders will certainly buy and that will push the market higher. I think there's no doubt about that. The other thing I should note this morning, I don't have a chart ready for you, but bonds are rallying hard this morning, which means yields are coming down, and the yield curve is flattening. The 3-month 10-year yield curve, which is what the Fed looks at, is going deeper into inversion this morning, and the 2-year 10-year, which is the one we've tracked historically, is getting close to inversion once again. Now, those are your classic recession signals. We haven't had a recession since World War II that wasn't preceded by an inverted yield curve. They don't necessarily happen immediately following the inverted yield curve, so history suggests we still have time for this expansion, but they are historically ominous signals, and for very good reasons, and we've touched on that before, and I probably will again going forward. Okay, so there's the charts for you, and in closing, I'm going to pull over from a recent blog post. Here is the S&P 500 index for the last 22 years. These scores here are our macro index. We call it the PWA macro index. Today it's 86 data points. We've been doing it since the summer of 2017, but I back tested it at key areas all the way back to 1998. And you can see back here, this is what typically goes on, and this is what I was illustrating in that blog post. You see we rolled over to a -10 here in the early 2000s, and the market actually rallied almost to new all-time highs before it rolled over. Here, our index rolled over big time into the red. Market rallied to all-time highs before the economy rolled over into the worst recession in modern history. And in here, folks, we were pretty sanguine the whole time, and we weren't scoring an index, but we were looking at the data. And even in here during the European debt crisis, we held tight in our allocations and we didn't hedge like we are right now. Same thing last year. In fact, you may recall in my commentaries, I was very sanguine last year throughout this whole big 20% decline. Why? Because we were still getting decent scores on the macro in our index. Here we are, virtually at all-time highs again. And here I am, sounding almost like a doom and gloomer. Not really, but definitely have a cautious tone that we didn't have back in here. But that speaks to what we're seeing in the macro. Now our index has improved. We had 5 weeks in the red. Last week we got just above the line into the green once again. But all of that happened in the financial market sub-index, which means it was really just a factor of the market rebounding and showing good things in those indicators. Those are indicators that very well could influence the economy when it's all said and done, so they are legitimate. But in terms of the overall real macro scores and our financial stress sub-index and so forth, it still pretty much paints this kind of picture, which has us cautious, of course. And then, of course, when we look at conditions, we look at the macro. Our job is multifaceted, but really on the surface is twofold. One is, what are odds of a bear market? What are odds of a recession in the foreseeable future? And then what happens underneath the surface? And that basically says, where do the risks lie? Where are there things we need to be concerned about? Well, as I've suggested here of late, and this is what says to me that the next one could be a real doozy in terms of the bear market. Take a look at the corporate debt picture in the US. Here we have the last 3 recessions, and this is corporate debt issuance has been off the charts. So companies are indebting themselves more and more and more as every day goes on. And you can just basically just take a look at that, and then take a look at how that trajectory tends to look prior to recessions. And it's really always about the debt in terms of the depths of the recessions. Basically, what happens when the economy turns south, some of these credit ratings go below investment grade, and pension funds, for example, have to sell them. And just the very circumstance where we have higher debt service responsibilities than we have revenue to satisfy them. I get that they're issuing this debt at very low interest rates, but the fact that they are issuing boatloads of it does very much offset the fact that it's at lower rates. In terms of the consumer, showed you this the other day. This is total consumer debt. I will say as a percentage of GDP, it's not that ominous looking, but nonetheless, consumers have a lot of debt. This is what bothers me. This was last month's spike, and the bulk of that was credit card debt. Kind of a late cycle thing. Look at it here before the big one. Look at it in here before the one before that. Somewhat of a spike before the one before that. Those last 3 recessions. And then, of course, we know this already. Government debt. This data, for whatever reason, I only have it back to 2005. That's as far as the chart would go. Tried to get it back further. But this is just U.S. government debt being issued. And we heard this morning, Treasury Secretary Mnuchin said that he's seriously looking at 50-year U.S. Treasury bonds next year. And of course, that sounds like what's going on in Europe. And you've heard the president this week. He wants 0 interest rates or lower. Well, I can tell you folks unequivocally, that has not worked in Japan, and it's not working in Europe, and it won't work in the US. It'll just exacerbate the issues that I'm concerned about that we're going to have to deal with during the next recession. I don't think we're going there anytime soon, but I'll say this, the fact that we have higher interest rates than most of the rest of the developed world, if not the highest, and our currency is strong, that really speaks to our strength as a country. We don't want to artificially create an environment with ultra low negative interest rates when that's not really justified by our economy. All kinds of distortions, all kinds of misallocation, and all kinds of money runs into riskier assets that ultimately make for, frankly, one hell of a mess when it all unwinds. So we're not there right now. There are circumstances. I think there are externalities, if you will, to sound like an economist, or exogenous factors that could unwind positively before we get to a real bad place. And you could actually, believe it or not, have me sounding very optimistic and have us accommodating for that optimism within client portfolios. Folks, that's not where we are right now. So I'm here to tell you we may be looking at new all-time highs and more in the relatively near future. And until the fundamental backdrop improves and we begin seeing better indicators on the charts, we're going to ride a slower train on the move higher to protect against a crashing train if indeed the move is lower again in the foreseeable future. Stay tuned, lots to come, and we will keep you up. We will keep you up to date as we go along. Thanks as always for watching and listening. Talk to you again soon. Bye-bye.